There was a 800-acre parcel in Costilla County, Colorado, okay? It's this beautiful, like, nice rolling hills, road frontage on all 4 sides, and some internal road frontage, and I think I could have bought it back in the day. I don't remember exactly what it was, but I think it was, like, sub 200 an acre, $200 an acre, and I think now, like, if I would have cut it up just into simple subdivide into 40 or 80-acre tracts, I probably could have sold it $1,000 an acre, and that's probably very generous, like, on
Wow.
the low end, but I didn't know how to do it back then. I was like, "Ah, no," and I just moved that deal along in the CRM, closed it out, and continued on my day. If I had just brought it to somebody, 'cause I didn't do anything with it anyway. If I just brought it to somebody who's like, "Hey, this deal came across my desk, too big, I'm out. Here's the leads info." They're very motivated to sell at $200 an acre, and I'd gone to do that to 10 people and or however many, and I was like, "If you get it done, just give me 10%, right?
Yeah.
Or give me a fee or something on the back end, have fun with it." Man, I probably would have made so much more money. I would have met a lot more people, and I would have started doing bigger deals a lot quicker.
Mhm.
So I'm a big fan of the partnership side. People get stuck in the 10%, the 20%, like how much more, like how much equity do we give up? Land is a risky game. And asking, especially in this market, asking somebody to give you a lot of money for a land deal, I think it carries a lot more risk than most people really understand. And so give the person what they're asking for, especially if it's a gateway to get you to like the next level of doing deals. Huge proponent of that.
That's great information. It sounds like there's some fat tails in land, as Nassim would Taleb would put it, but where we underestimate the risk that's associated because of this nice market that's been around for 8 years or however long it's been. What do you think? So there's hedging your risk, just being aware of it, not personal guaranteeing, being reasonable with JV deals because take into account that risk. As the market has turned a little bit here, what do you think the opportunity looks like in land, or how's the opportunity shift? Obviously, you can start possibly picking up better deals, but then it's harder to dispo them. How do you think about that? Like, where's the opportunity lie within that? How careful do you want to be about sweeping the floor, picking up a bunch of deals because they're cheap, but then not taking into account that they're going to be harder to resell? Like, how do you factor that
Yeah.
in your mind?
So when I started in 2016, flipping unusable land in the middle of nowhere, okay? And I say unusable, it's usable, it's more recreational than anything.
Mhm.
And I think everybody thinks this when they start land, they're like, "Who in the world is buying this?" And that's what I thought, and really until I had done a few deals, frankly, like, even a couple years in, I was still like, "Why are people buying this?" Like, what? I get it, it's lower cost, they can't afford stuff closer to the city, etcetera, but there's a real, especially if you're unfamiliar with the marketplace, like, who is buying this land? And so back in 2016, 2017, and again, all the way up really frankly through today, like the market's been great. There's been a lot of money out there. If people wanted another car, they wanted to track the land, there was discretionary spending money available. And in my opinion, that's where a lot of recreational type properties fall into. They fall into like discretionary spending budget.
Mhm.
Okay, because you're not living on it most of the time. You're not living on it. And if you are, it's in a different bucket. It's not discretionary spending. It goes into a housing bucket, which is like hierarchy of needs, first one or second one or whatever it is. So like completely different bucket of capital. So I think about as the market is shifting, I'm thinking about where do we do deals? How do we do deals? The number one word that comes to mind is liquidity pools. Like where is the liquidity right now? Okay. And I think that depends a ton on the market you're working in. I think it depends a ton on the types of deals that you do. Again, the types of capital you have access to. But what I'm thinking about right now is where's the liquidity at? Okay. And it's still a question I'm trying to answer right now for land. There's different buckets of where does land fall into, and stuff that is like housing related, that like roof over your head, to me is working a lot better right now than recreational land because there's a true use component to it versus a theorized use component. And as the market softens, the first thing that goes away is discretionary spending budgets, right? The Call it a house, a car, a boat. My friend Justin Sleva calls them the bass boat properties. Can you afford the payment on a bass boat? Well, then you can afford the payment on the piece of land, right? It's like in that same bucket of consumer spending. You can afford your $800 bass boat payment, you can afford the $800 land payment. When the market tightens and not as many people are buying the boat, buying the extra car, i.e., buying your properties from you that you're buying and flipping and selling, that bucket of money dries up a little bit. And so I think it's important to figure out in your market, where are the liquidity pools? Where I'm seeing them right now, things that are more closely related to housing, okay? If you can think like entitlement land, if you can think about land that's closer or within city limits that is truly like the day you close on it has a clear path to being built into a house or a home or apartment or whatever, right? There's because a lot of that comes from institutional capital. When subdivisions get built, it's oftentimes financed through the bank, which is institutional capital because it's subsidized by the government for home loans, right? When we just sold a lot in Houston, it was a tear down lot. We bought it for 40 grand, we sold it for 200 because somebody had $1 million construction loan to tear the existing house down and build $1 million home on it. That was the liquidity bucket. It was tied into that. Versus if I was going to sell the property 2 hours outside of Houston, I need somebody who's just looking for recreational property and isn't affected by, you know, inflation and tightening budgets and all that kind of stuff. So I think it's really important to figure out where is the liquidity in your market. Up until now, there's been an immense amount of liquidity in the market as a whole. So if you're going to sell something that has a recreational use case, it's fallen into the fact that everybody's had money over the past 7 years. And I say that as a holistic statement. Not everybody's been as blessed, but it's been easier to spend money. It's been easier to get access to money. And as we went through COVID and land values went way up because sellers typically lag a few years behind in land because they're old and it takes time for like them to catch up to the market. And budgets have tightened. I think like recreational stuff has been harder to move. I think that's what a lot of people are seeing. And I've seen as well with a lot of our deals. So I think really thinking about where's the money, right? Where's the liquidity in your market? And like where does land fit in there? So that's where I think about it right now. Very different, very market dependent on what you're working on. But wherever the money is, that's the markets that I want to play in.